Hello, everybody, and welcome to Stablecoins Are Killing It, episode number 3. I'm Luke Kerner with Crypto Mondays, which is now in VR, virtual reality. And we've got a great show for you today featuring Roy Lerner from Wave Financial. Roy, welcome. Sam Kazmian with Frax. Hey, Sam.
Hey, how's it going, guys?
Okay, hopefully you'll get your camera working. And Josh Frank with the tie. Welcome, Josh.
Thanks for having me.
So each of our speakers are going to share their views for 5 to 10 minutes. And we're going to spend the rest of the time answering questions from the audience and answering and really involved in a dialogue. So this is more of kind of a show than it is just a webinar. So if you have a question, please ask it via the Q&A tab in Zoom. And if we take your question, we will make you a panelist, open up your mic, and open up your video, and enable you to engage in a dialogue with panelists if it's relevant. And I'll ask the panelists to each answer any questions we have in 60 seconds. Therefore, we'll get through a lot of questions. This call is being recorded. We're going to post it on YouTube shortly thereafter. And also, we'll do a blog post saying the 5 or 8 or 10 things that we learned from Stablecoins Are Killing It, number 3. And with that, I'd like to turn it over to Josh Frank. Josh?
Hey, thanks for having me, Lou. So I'll focus a bit more on the data than the opinion side, but can start by saying that I am a big fan of stablecoins. I've always thought that stablecoins were one of the best use cases for crypto, especially from a foreign remittance perspective. When you have coins that, when you have countries that have hyperinflation, and when you have, workers, for example, working in the United States, or I, lived in Hong Kong growing up, and you have, Filipino immigrants that are working there, a lot of times they have to send money back home. And, I've always thought that stable coins, as opposed to Bitcoin or other cryptocurrencies were the best way to do that. So that's kind of, my background in a little, perspective, but, kind of delving into the data. Can you guys see my screen here?
Yeah, we can see it. And Josh, why don't you give people just a real quick background on the tie?
Yeah, sure. So we are the leading provider of alternative data for digital assets. So we work with a variety of market participants, everything from quantitative hedge funds to discretionary asset managers, sell-side researchers, publications, law firms, and regulators. And we provide a bunch of different data services. Our core data service is a quantified sentiment data feed. So what we're doing is we're analyzing investor emotion on social media and providing that as quantified data to investors. We also more recently built the first corporate actions and significance developments feed for crypto. So we're parsing everything from, we read through every single SEC filing in real time, looking for mentions of crypto, to every court case, to every regulatory ruling, to every announcement from coins or exchanges. And what we're doing is we're providing that data as, real-time actionable information to a variety of market participants. So that's kind of our background.
Hey, can you close the curtains behind you? Because with the sunlight coming in, you're just a little washed out. There you go.
Yeah, sure. I can hold up. This should at least help a little bit.
Yeah, there you go. That's a little better. Thanks.
So to the data and to just dive in right away. So if we look at Tether, which is, by far the largest stablecoin, I think at this point represents about 90% of the stablecoin market, if I'm not incorrect. What we're looking at here, the line itself is trading dominance, or the percentage of overall crypto transactions that include a stablecoin, or include Tether for that matter. What we've seen is that since December of 2017, Tether's increased from about 6% to over 30%. So a 5-fold increase in the number of crypto transactions that are including Tether. And what we've seen across the board is widely that, in the past, a lot of altcoin trading was done between, done between other cryptocurrencies like Bitcoin as the base pair and altcoins. But we're seeing a shift to where a lot of that trading volume is actually occurring through stablecoins as well. But if we look at the area chart, what's even more interesting is I actually had to log this chart. But what we've seen is that the overall percentage of cryptocurrency tweets that are about Tether has increased from about 0.03% to, at its peak in April, upwards of 1%. So a 30-fold increase in terms of the percentage of overall crypto tweets that are discussing Tether. So if we kind of zoom in here into this year, what you're looking at is three different things. The first on the bottom is the percentage of notable news stories that the number of notable news stories that include Tether. And what we're able to see is that at the beginning of the year, January, February, there were a few news stories scattered here and there. But we're seeing, a massive increase in the amount of media coverage around Tether more specifically. So if we look at the dark blue line here, what you're looking at is the market cap dominance of Tether, and it makes sense. You'll see this giant jump on March 12th. The reason that occurred is because, Bitcoin and crypto crashed, and Tether is supposed to be, tethered or stable to the value of a US dollar. So, obviously its market cap would rise, but we've seen that even as Bitcoin is now at a higher price point than it was on March 12th, Tether's market cap dominance is even higher, and that's because of the demand for new issuances. And so if you look at that lighter blue line, which you can see is more of a steady increase, that's the 30-day average number of Twitter users discussing Tether, and that's gone up about 50% just from the beginning of the year. Something else to note just very quickly is that, one thing that we do is we measure quantified investor sentiment, and quantified investor sentiment on Tether hit its highest point in 3 years that we've ever recorded on April 18th. So sentiment on stablecoins broadly is definitely getting more positive. And then just kind of back to the market cap dominance metric, I logged this chart. The reason that I did that is just because Tether is so much larger than other stablecoins. But what we're seeing is, while Tether is growing and Tether is growing exponentially, other stablecoins are as well. I mean, we can see that, Binance, BUSD, Binance's US dollar stablecoin didn't exist a few months ago. And, now it represents about 1/1000th of the overall crypto market, which is not giant, but it's definitely notable in such a short period of time. And we can see USDC and other stablecoins are definitely growing. Something else to note is just, this is looking at news mentions. So these are the number of news stories that are mentioning stablecoins. And, we've seen that, since a couple of months ago, it's really on this giant surge and this giant uptrend and likely to, if this trend continues, hit an all-time high. Then a couple just more interesting things that we noticed is the fact that stablecoins are increasingly being talked about in places other than crypto publications. So one notable place was JD Supra, which is one of the largest legal publications that talks about law and news and things like that. And we've seen mentions in places like JD Supra and Bloomberg Law and Law 360 and in a bunch of places that we weren't necessarily seeing stablecoin mentions before. When it comes to central bank digital currency, we're also starting to see a bit of an increase, but it doesn't seem to be as apparent. You can kind of see, where they're being talked about. Something interesting though is you can see a bunch of publications like O'Daily, Chain News, and Bitcoin 86, and a few other ones which you may not, be familiar with. And the reason that you're not familiar is those are actually Chinese publications. And we're seeing that, which makes sense as China moves to launch a central bank digital currency, that there's a lot of conversation that's occurring in these different places. And it's what's actually interesting and something that I kind of pose, potentially as a question to the other panelists or to the audience is that if we zoom into Tether, the vast majority of news and conversations are actually coming out of China, which is something that was very surprising to us. So, you can see the largest publications by far are all Chinese. The top 4 publications in terms of mentions of Tether are all Chinese. And if we look at, these are the top 20 most discussed topics more broadly in crypto and news sources, and we parse through about 1,200 different news sources. The 2 that are trending the most in China are, one is DeFi, and 44% of the news stories are in China. But Tether, 71% of the news stories around Tether are occurring in China. And I think that may be related to central bank digital currencies, but I also think that's related to the fact that outside of the United States, people are now quoting, the price of cryptocurrencies in Tether as opposed to in US dollars. So, something that we found that's kind of interesting. I don't know if I necessarily have a great explanation for why that's happening, but those are kind of the theories that we have.
So that was great. The chart that you had on Tether and percent China was obviously really super interesting.
Yeah, I mean,
And
not something we expected to see, and it's interesting to us as well. I mean, we had noticed DeFi, but it seems more recent that China's seeing, you know, more conversation around stablecoins.
were you able to do, or can you do at the time we have that on any of the other stable coins, just to see, be interesting to see USDC? You know, I would expect Binance maybe to be even higher than that.
Yes, you can give me a couple seconds.
Yeah, I think that would be super interesting. And Roy, Sam, I don't know if either one of you, you know, are surprised by that, but I think that's super interesting.
Yeah, I mean, so I think that these trends will continue to happen. I've been saying similar things since 2018, actually, but you know, back then, even less people really believed that stablecoins were going to be that big, because everyone was doing ICO tokens and these DApp tokens. But I think as more decentralized finance products and more movement of you know, actual money and usage of money happens, that stablecoin volumes, just like we're saying, are 100% going to be increasing manyfold.
Yeah, just quickly to answer your question, Lou, you know, I took a look. It doesn't seem to be as apparent for like a USDC. We actually don't track Binance USD in terms of news mentions yet. But we're definitely seeing a number of news stories coming from China about USDC and likewise on DAI. But you know, the majority of news stories on DAI actually just come from MakerDAO's own blog.
Okay, that's interesting. And also, what about you didn't have much on Maker?
In terms of the where Maker is being talked about, or
Well,
itself?
anything about Maker, just in terms of, you know, I realize it's smaller, you know, but it is, from a decentralized standpoint, it is not decentralized, but it's more decentralized to the degree that you believe that it's not binary, I think, than the others, and are there, you know, they're arguably on their way to being decentralized. So it'd just be interesting to.
Yeah, so this is number of Twitter users talking about Maker, and it also is near all-time highs as well. So similar. And if you look here, this is the, you know, the top sources talking about Maker, and below Maker, the second, you know, the second highest source talking about it is Chain News, which is a Chinese publication, which is actually talking about 50% more than Cointelegraph. So kind of a similar trend as well.
Okay. Okay. Well, that's, yeah, really great stuff, Josh. So thanks a lot for sharing that with us. And again, if anybody has any questions, feel free to put it in the Q&A. And with that, we'll turn it over to Sam. So Sam?
Yeah, can Roy actually go first if he's speaking, so I can finish up a little bit of some of the stuff that I wanted to show?
Sure, that's fine. So Roy, you know, I know you didn't have slides to share, but you had some thoughts that you wanted to share. So, you know, we'd love to hear them.
Sure, absolutely. Thanks, Lou, for having me on. Just a bit of background about myself. I'm a principal at Wave Financial. We're an early stage crypto fund. So a lot of my insights are probably more in the lens of an investor in the space. I think, you know, everyone is pretty rightfully excited about stable coins, just given the clear product market fit. You know, the market cap has really exploded last, you know, 12 to 18 months, just hit 10 billion. It's a $1 trillion total addressable market. So, you know, everyone is now rightfully, you know, paying attention. You know, I think we're obviously very early. There's a ton of room for experimentation. You know, we've really only seen a few flavors of stablecoins out in the wild. You know, you have the Tether, you know, one-to-one backed supposedly with collateral. You have the slightly more regulated flavor with USDC. You also have the crypto collateralized stablecoins like MakerDAO that include governance. But now that MakerDAO has actually shut down single collateral DAI, you don't have you know, a single collateral governance minimized stablecoin. So I'm hopeful that we'll see some experimentation there. You know, there's tons of opportunities on, you know, partial reserves, algorithmic reserves. We still haven't really seen a ton of, you know, tokenized traditional assets being used as collateral, although MakerDAO is heading in that direction. So all in all, I think, you know, really, if you think about all of these different combinations of, how to build a stablecoin really in the early days. And, I think if you, from my perspective, really like the most exciting thing about stablecoins is like, if you think about what in crypto today is truly a 10x better experience, I mean, paying with a stablecoin in a lot of use cases is really 10x better, both from kind of two angles. One is just on cost. So, you can have basically the gas cost depending on how many Ponzi schemes are running on Ethereum. Hopefully, single cents, as opposed to, sending a wire.
The number of Ponzi schemes on Ethereum.
Yeah, I don't know if you guys have been watching. There's been a couple that have eaten up the gas costs and have raised the floor. So gas is a little expensive on Ethereum these days, but
we did an $1,000 transaction the other day with one of our customers, and I think it was 12 cents in gas fees.
Yeah, so like barring any alternative people that are competing for block space, like it truly is a cheaper way to send money across the world. And the settlement, I think, is really where it shines in terms of like being able to settle a transaction in minutes versus days for all the correspondent banking systems that you would need to send a wire. So like a really simple investment or a simple like use case for us as a venture fund is just funding investments in USDC versus like sending a wire, which is just like easier for us because we don't have to like go like it is a pain for something as simple as like sending a wire to a company that's not in the United States. So like USDC for
have you done that?
Yeah, so we have. We've I think like I wish like in 2017 this was like the norm. If you think about like a lot of the treasury management issues that like ICOs had in terms of like raising in ETH and BTC, like half of the like a majority of those would be mitigated if they had just accepted USDC. And the reason that they accepted ETH and BTC was because it was so easy in terms of receiving capital. And so yeah, so I think like for sure that it's heading in that direction. And the people that are going to like dog food and actually like figure out how to set up a wallet are going to be the crypto native companies. So even just like beyond something as simple as like funding and investment, we've seen things like trading, speculation, obviously like dominated by Tether as a trading pair across all of these, some of the Asian exchanges. Remittances, I think, is definitely a really strong use case in terms of just the cost savings that are potentially available there. I think there's a lot of work that needs to be done in terms of the infrastructure to get the cost down in terms of the on and off ramps. But we're really excited to see a lot of the progress there. Even just like dollar.
When you've actually made investments using USDC, what were the transaction costs? Do you remember? Or?
Yeah, it was just ETH gas. I mean, to send it's very simple to send USDC.
So
yeah, 10 cents. Very sub $1 for sure. So, depending on how fast you want it to confirm.
So in terms of, but you said that they need to address that. So I'm just trying to put that comment into context.
Sorry, who needs to address that?
No, I'm sorry. I thought you said that they need to.
I think you're talking about fiat off ramps. So how much does it cost the company accepting? Yeah.
Yeah, I was more mentioning just like remittance in general. Like, let's say, I have family in Israel. I want to send money to my family in Israel. I could send them, a stable coin, but for them to actually like take it out of the crypto rails and put it into the traditional banking rails, there's a point of friction there. And so if you look at the costs, the cost savings of, the wire fee versus the gas costs, there's for sure cost savings, but then you're tacking on additional fees by, charging them on the off ramp. And so Josh,
it's kind of similar to, no, I was going to say for us, it's, it's kind of similar to a Stripe fee, right? When we accept transactions in Stripe, we pay 2.9% plus 30 cents. As of now, it's pretty similar to that.
Yeah. So I think where like the real benefits will come is like either the dollars stay, like the stablecoins stay in the crypto ecosystem. And you basically give users a reason to keep their dollars into the crypto world. And I think we've seen a ton of like really interesting things come up. Like one is just yield, like dollar yield is a huge pull for getting stablecoins to stay into the crypto rails. So things like Compound, DYDX, even things like BlockFi. You're seeing all of these, these applications that incentivize people first to convert their dollars, their traditional dollars into stable coins or crypto dollars, and then keep them there because they actually are more productive in the crypto rails. So one thing that we're really excited about is this this kind of yield as a pull mechanism to keep crypto dollars within the rails.
As an investor, have you invested in anything in that space or in the kind of the more broader, I guess, stablecoin space?
Yeah, so we do have we've made a number of fund-to-fund investments, and within the fund-to-funds, we've gotten some exposure to things like Maker and Saga. I think it's fun to kind of think like, I think everyone at this point kind of agrees that stablecoins are going to be a very broad trend, and so there's a number of different ways as an investor to kind of capitalize on that trend. I think the one obvious one is to back a couple of these projects that hopefully have the correct token economics to accrue value should their particular design take off. So things like Maker, if the DAI stablecoin takes off, there's a clear balance with the Maker token accruing value. So things like that are one very straightforward way. If you take the second order, all of these stablecoin, all these crypto dollars are being built on Ethereum, and so there's potentially a case to, that Ether will accrue value because these stablecoins are now using gas. They are, putting their security on the Ethereum blockchain. I think there's a couple of different tweaks that need to happen, and maybe we can talk about this later in terms of Ether's ability to accrue value as gas costs, but like Ether is potentially a way to capitalize on this trend as well. I think the exciting thing, or the other straightforward one is just like the exchanges, the fiat on and off ramps, some of these like automated market makers that are coming that will basically be like toll gates as people transact and bring more crypto dollars into the ecosystem. And so like it feels like the exchanges like never lose. And I think they're really gonna capitalize on, like they're if you think about the on and off ramps, like they're gonna take a toll, and then there's also just a significant trading volume that occurs, and you can even think of like FX eventually, potentially coming onto Ethereum, and then there's things like Curve and all of these stablecoin specific exchanges that I think are going to start to take off as well. So we're looking at it from a number of different angles.
Yeah, that makes a lot of sense. So thanks a lot, Roy, and thanks for sticking around for the Q&A section. So we've got a few questions, and we'll be getting to those after Sam gives his talk about Frats.
Cool. Yeah. Let me just figure out to screen share. It's a pretty short slide.
Yeah, so there's just the button down.
Yeah, there we go. All right, can you guys see this?
Yep, there you go.
Okay.
Good job.
Sweet. Yeah. Okay. Hey guys, I'm Sam.
You just want to make it full view screen.
Yeah.
Yeah. Go to the yeah, there you go.
Hey guys, I'm Sam. So I'm actually co-founder of Everpedia. Wave actually is an investor in Everpedia. We're the largest EOS DApp. And like I was saying originally in the video, I've been really interested in stablecoins since 2018. So I have this project I'm personally working on with me and a few friends called Frax. It's kind of a passion project. We haven't raised money. We just want to release it in a truly decentralized fashion. Just wanted to.
I don't think. Do you remember how much Satoshi raised?
Yeah, that we want to do the Bitcoin way, right? Not the ICO way. Yeah, that's a good one because that's how we really think a lot more people will get behind it, so to speak. But yeah, I just wanted to quickly kind of review I don't know how in depth the audience is and stuff like that, but one of the things when I always think about stablecoins is I started getting into them because I realized the term cryptocurrency is kind of a misnomer, because all of the cryptocurrencies, quote, quote, right, have a fixed supply, right? They're all like digital, like gold and scarce assets that don't have any supply changes or any kind of monetary policy, built in. To a lot of people, that's actually really good, right? You have a lot of people that say gold should always be used as money, and that's fine and everything. But the thing I noticed is there's no monetary policy on a lot of these cryptocurrencies. There's just, there's 100 million of these tokens, there's 50 million of those tokens and things like that. And in that situation, they're always the price of the actual token is always just a product of supply and demand. And if the supply is constant, right, the price wildly fluctuates with demand. And so the thing that I think is also pretty telling is the next observation, is that because of this situation of all of these digital assets being highly volatile, you have Bitcoin with its original narrative of peer-to-peer cash now socially rebranded as a store of value and digital gold. So one of the things that I kind of always argue with Bitcoin maximalists and stuff like that is why did this actually occur? I was early enough in crypto. I was in 2013 and around that era, the altcoin era, and everyone was still calling it, digital cash, and everyone was thinking about Bitcoin as, I'm going to buy my coffee with it one day and stuff like that. Do you guys remember that? You guys know, like everyone was, saying we're going to buy coffee. Yeah.
Exactly.
Right. Yeah.
No, it doesn't happen. I have not bought coffee yet.
Yeah. And no, I mean, what's ironic that I always say is that Bitcoin actually ended up being more for movement of very, very large amounts of money rather than very small micropayments, at least in its structure today. It's more like gold than it is paper money, right? And so obviously the last two observations, there's a really huge demand for using crypto as money, but then there's all of these things like Bitcoin rebranding away from money, right? And then not being able to scale to be used as money. So it's just the right, situation and the right environment for stablecoins. And so the next thing I just wanted to review, we kind of talk about everyone, knowing all the different categorizations and stuff of stablecoins, and we kind of talked about, the different kinds. But I just wanted to categorize these as there's three main types. Everyone always really, when they try to go and categorize and write history about stablecoins, so to speak, if there's going to be that kind of historical record, there's three main types. There's crypto-backed, like Maker, which is basically the stablecoin has a lot of cryptocurrency.
So you can assume that the people on the call are pretty sophisticated. So
Okay.
You don't have to do 101.
Okay, so I just wanted to get that through. Yeah. And then, so with Frax, it's a 2-token algorithmic stablecoin. And so it doesn't actually fit in any of the reason I was talking about is it doesn't actually fit into any of those categories like a hard kind of like it's not the same thing as any of them. So it's a 2-token algorithmic system. And it's pretty simple. At the beginning, when you create Frax stablecoins, they're simply backed one-to-one by other stablecoins. So in this example, I wrote out Tether, and there's different types of collateral accepted, USDC and Binance USD. And the idea with Frax is that with algorithmic stablecoins, the reason none of them have been able to, in our opinion, have been able to reach market ubiquity and actually be successful, there's none that are actually released, is because when they're released, they're all 100% completely without collateral. There's no collateral backing any of them, and they're algorithmic at the beginning. With Frax, it's exactly the opposite. It's actually one-to-one, perfectly backed at Genesis, and then it slowly moves away from 100% collateralization with incremental steps into a fractional reserve phase, and then a hopefully one day, right, if it's going to be as big as Tether, bigger than Tether, then into a fully algorithmic phase. So kind of how it works, I wrote out the very basic steps here. Is originally when Frax is released, you can print Frax stablecoins by putting in other stablecoins as collateral. You put in a piece of Tether and you get some Frax out. And that'll happen, and so people will use Frax, and you can always redeem it for the collateral. At some periodic increments, the algorithm has basically every 10,000 blocks or something, so to speak, there's new Frax stablecoins printed in the system and then auctioned off for the Frax share tokens, kind of like a stock buyback, right? You print money and then you buy back the share tokens. This actually lowers the collateral ratio of Frax to under 100%, right? If you print some and then you auction it off, now there's only 99% collateral backing because there's more Frax stablecoins in circulation. Then one of two things can happen, right? If there's a lot of demand for Frax, if people still want to hold it and they still see the confidence in the system being able to stabilize the price, it should trade at $1, even though it only has 99% collateral. The other thing that can happen is that the market can only value it at 99 cents on the dollar, which is the new collateralization ratio, right? And then the price could drop by a cent. And so if the price of Frax drops below $1, then the system does exactly the opposite thing, right? It prints out Frax share tokens, which is what it bought back, and then it purchases the Frax stablecoins until the supply and price recovers. And then in the next step, in the next 10,000 blocks or something, the system attempts to test out the fractionality of the stablecoin again. And so the idea here is as it grows, people will have more and more confidence in how much of the system needs to actually be collateralized and how much of it can be algorithmically stabilized. Perhaps it's 10% algorithmic, 90% collateral, 20%, who knows, right? And so,
Sam, if you go back to the three types of stable coins, just for
yes, that's what I had. Yes.
Yeah. So obviously, the crypto backed, whether it's crypto and the fiat backed is backed. If you looked at the algorithmic, obviously Basis, was an interesting project, but had regulatory issues. Was there anything that you learned from what Basis was trying to do?
Yeah. So, well, first of all, that's also part of the reason why this is a project that we're not trying to raise a single dollar. If everyone remembers, Basis raised a crazy $133 million back during the peak, and then they were under a lot of regulatory scrutiny. So that's one issue. The second one is design, right? If you guys remember what Basis was, it was actually kind of similar to part of Frax. There were these base share tokens, and then when Basis printed the Basis stablecoin, they would give them away to the share token holders. And then when they wanted to retract the supply of Basis stablecoins, they would print these Basis bond tokens, right? And then they would try to purchase back the stablecoin with these Basis bond tokens. Now the issue is there's no collateral in the system, right? There's absolutely none. When they were going to launch the system, which they didn't, and they gave back the money, the Basis stablecoin was not backed by anything. There was zero collateral. They were just going to, print 10 million, Basis stablecoins, put them out into the market, and then hope that it was going to trade at around $1. And if it wasn't, they would have to buy some back using the bonds mechanism and all of that stuff. With Frax, we don't do that, right? With Frax, when we launch it, it's 100% one-to-one backed, right? So on Genesis, you have to put in, USDT, or you have to put in a USDC 1-to-1, exactly 1-to-1, and you'll get back one frac stablecoin.
Okay.
Yeah.
And so it's great. I want to open up the question. So let me just finish. What's your the plan for deploying fracs?
Yeah, so we are going to be on Ethereum, and then and I just had some news headlines that always excite me about stablecoins. So we're going to launch hopefully in the next 2.5 months. We have to obviously get a security audit, and then open source the contracts, and then we're going to be possibly having an implementation on EOS, but like was said before by Roy, a lot of DeFi stuff is happening on ETH, so we're committed to building it on ETH right now.
Okay, well, terrific. Well, thanks, Sam, for sharing that. Super interesting stuff. And with that, we'll open up to questions. And our first question is from Anna. Hey, Anna.
Hello. My question is basically to Joshua. I was very, very surprised when you were saying that 71% of all of the articles about Tether are from China, and it sort of made me think. Do you have any idea or opinion how much of the Twitter activity could be due to bots and Tether or stablecoins in general, and also if it's very different than from other cryptocurrencies?
So yeah, so to kind of separate out, there's I think 2 points there. So when I was talking about the 71%, that was actually news. So that's 1,200 different news sources. So also very interesting to me. We're not seeing the same thing in terms of the percentage of tweets coming from China, but that's because people in China don't really interact with Twitter so much. But in terms of your point on bots, so we tend to find, just like in the digital asset market, a very large percentage of trading volume is still manipulated, right, by a lot of these illiquid exchanges that are trying to attract new volume, and rank higher on CoinMarketCap. The same thing goes with a lot of cryptocurrencies, right, where what we'll see is, in some cases, coins have these absurd tweet volumes, Electronium, for example, and some of these other cryptocurrencies, and that tends to be manipulated. The thing about Tether is nobody's really trying to manipulate the price of Tether. So there's not as big of an incentive for bots to come and try to pump and manipulate conversations. So I would say, broadly speaking, Tether has less fake or disingenuine conversation than other cryptocurrencies. But there is a decent percentage of it which come from the accounts like Well Alert, where they're basically just talking about large on-chain transactions. So that is a percentage of the conversation. And I think part of the reason that, the number of conversations, from a raw point of view, like the raw number have gone up, is because there are these massive, transactions that are happening on chain, right? Where another $100 million worth of Tether is printed on Tron or on Ethereum or anything else. And people start talking about that. So that's, and that, originates from, I guess, a bot, which is, like Well Alert on Twitter, if that answers your question.
Yes, it does. I was just wondering if, well, basically, you said that you think there's way less bot activity on those, and that was my main question, I think. Thank you.
Thank you.
Okay, thanks, Anna. Our next question is from Ganesh. Hey, Ganesh, good to see you.
Hi, everyone. Yeah, my question to Josh.
I'm sorry, just you tell the audience, it'd be great, to who you are,
Yes.
your background, yeah.
Oh, right. So, so I'm studying cryptocurrencies, in particular stable coins, and so my question to Josh is on the sentiment analysis. Has it got a lot of predictive power at a high frequency of Bitcoin and other crypto prices? And with the SEC reports, like, do you get measures of how much take up there is of these cryptocurrencies? So like sort of general statistics on like which technologies firms are adopting, like, is that something you can get from the legislation?
Sure. So let me address that second question about.
Just FYI, so Ganesh was earlier been at UC Berkeley, and now he's at the University of Warwick in the UK.
Very nice. Very nice. So to your second question, I'll answer that first. It's a bit quicker. So in terms of what we do with the SEC filings, for the most part, we're providing that as a raw feed to funds. I'm not 100% sure what they're doing with it, but what we've seen is a very sharp increase, especially during this earnings call season, in the number of SEC filings from publicly traded companies that mention cryptocurrencies. On average, we're seeing about 5 to 10 SEC filings a day, which is massive, mentioning cryptocurrencies and blockchain technologies. From parsing through them myself, the vast majority are mentioning Bitcoin and Ethereum, but I went through one yesterday that was talking about Litecoin, and there are definitely other things that are popping up in there as well. But for the most part, just like this market is 66% Bitcoin, same thing goes with SEC filings. A lot of what we're seeing is, Square talking about Bitcoin, or, you have a couple publicly traded companies now that are interacting with Bitcoin more frequently, and that's what they're discussing, as well as blockchain more broadly. In terms of your question about using Twitter to predict price, definitely that's definitely the case in digital assets more so than in other assets. So a very quick background on our firm. We were, I guess for lack of better terms, an offshoot of a company called Social Market Analytics. And they're a leading provider of sentiment data to traditional quantitative hedge funds and financial firms. So they sell data on equities, futures, Forex, fixed income, commodities to your Fidelities, your Barclays, CMEs, CBOs of the world, as well as, large quant funds. And so, as we started talking to them before we started our company about 2.5 years ago, I guess now, we were like, hey, if sentiment can predict movement as part of a multi-factor model, right? Not on its own, but as part of a complex model, the movement of an equity, for example, Apple, where Apple has earnings, it has dividends, it has revenue. On crypto, where there's nothing fundamentally driving the value of these assets, a large percentage of the movement is driven by the wisdom of the crowd, right? And the idea that in the land of the blind, the one-eyed man is king, right? In the space, there really no fundamentals, quote unquote, that are driving these assets. And we're starting to see that more with on-chain activity and things like that, but they're still lacking, fundamentals. So sentiment is definitely a driver. And what we've seen, I guess, broadly, just, in short, is when sentiment is statistically significant, when it's like 2 standard deviations from the mean, one of our measures of sentiment, that tends to lead upward price movement and downwards. But it's obviously more complicated than that. But broadly speaking, we've seen large sways in positive and negative sentiment, leading price movement, and the quantitative funds that are using that data are finding a lot of alpha in it.
Okay, thank you.
Okay, thanks, Ganesh. Good to see you. Our next question is from Luca.
Hi, thanks for having me here. I've been investing in crypto for quite some time, and I'm quite interested now in what is called, I think it's called stacking, which I think Roy was referring before at saying that it makes sense if you have some crypto, some dollars, to convert them in stable coins and apply them into the DeFi world and have a better return on interest that you could earn in elsewhere in the real economy, so to say. I was wondering, what are the risks that an investor will have to consider there? Are they mainly cyber risk, meaning there is no counterparty risk? Is there? What are the risks that you suggest an investor should take into consideration? Thank you.
No.
Sure. Yeah, that's a great question. I'll take a stab at it. I think it's really important to truly understand the risks, even though potentially the yields and the rewards are higher on DeFi. I think they're probably maybe a little too low given some of the risks that are apparent within the crypto ecosystem. So I think like the most obvious one, which you hit on, is something just smart contract risk. Which is essentially that the smart contract, which is holding custody of the, call it your DAI or USDT token, doesn't act as intended. And so that, I think we've seen a number of different security hacks and bugs within the Ethereum ecosystem. I think one interesting kind of counter that we've seen is the rise of kind of insurance to kind of safeguard against smart contract hacks. So something called Nexus Mutual enables you to basically essentially hedge and pay for insurance should a smart contract not act as intended. And so I think there's a lot of opportunities that we're seeing to kind of mitigate. But I definitely say smart contract risk is another one. Another one is really just kind of like maybe more in kind of like your OPSEC, your personal security, but these are bearer assets and you're holding your private keys. And so there's plenty of, if your assets are with the bank and you lose your password, you can, reset your password and there's someone at the other end. For some of these, DeFi platforms, like you are the buck stops with you. And so if you, mismanage your private keys or you lose, one of the wallets, it's really important to make sure that you can, manage those risks as well. And I'd argue like some of that stuff is getting more sophisticated, and there are better tools in terms like social recovery and multi-sig that are mitigating those risks. But I think they're still really relevant today.
Yeah, and I think also just to quickly add to that, don't want to get into too much depth, but MakerDAO almost shut down on March 12th when when the price of ETH collapsed and the vaults that were holding MakerDAO become under collateralized. So something to look at in depth, but generally when that happens, there are these auctions that start, and then there were no bidders in the auction, and one person was able to bid. So there are definitely a lot of risks with DeFi, and there's also lots of risk with centralized lending platforms like counterparty risk. So I think something that we're going to start to see come into crypto is tri-party repo. And there's one company that's starting to do that and is in the process of launching called Digital Gamma, where you're actually connecting the lender and the borrower directly. They're both putting up collateral, and you're reducing your risk on a single party, and both sides have collateral as part of the process. And I think we'll start to see a move towards more of that, because even myself, I'm holding, our company holds USDC. I am nervous to put that in a centralized lending platform now that does have counterparty risk. Even though I know we could generate 6% yield, I just don't think it's worth the risk for our business.
I think that's a super interesting, right? There's really no way of assessing the risk of these things, right? It's just this unknown risk. And it seems to me like we're, for some period of time, we'll have plane crashes, right? Where there will be, issues, whether it's a hack or a government or some, intervention or something. And we'll continue to correct for those. But right now, I feel like we're the Wright brothers, and, we've made like 10 flights so far.
Right. Don't put all your eggs in one basket.
Write that down. I would trademark that. Hey, Glenn, so Luca, did you get your question answered?
Yeah, absolutely. The only maybe thing I would add is that, yes, there are insurance, but then you bear the counterparty risk of the insurance in that case. So you have to assess the credit worthiness of the insurance itself. But yes, thank you very much.
Yeah, it's interesting. I mean, Nexus Mutual is kind of the reigning king of insurance in DeFi, and they're like tiny. So, it's interesting to see like this whole new industry start from its birth.
Yeah, I mean, DeFi more broadly is tiny. I mean, when the the market collapsed, the total value locked in DeFi dropped to like $500 million on March 12th. So it's, tiny from an all-time high of 1.2 billion.
It's interesting.
Long way to go.
We're at the beginning of this whole new industry, and so we don't know even like how to define things. And some people would define stablecoins as DeFi. And what makes me most excited about it is actually I don't see it. I don't see it as a subset of DeFi. I see it as something.
It's bigger.
Something that could be far bigger, because in fact it's not decentralized. Not that I don't love decentralization, but today, as we've already talked about, the on-ramps and off-ramps are highly challenging. But in any case, Glenn, so thanks, Luca. Glenn, you've got the next question.
Sure. And first, a quick intro, I guess, Lou?
Yeah, that'd be great.
Okay, so Glenn Rosenberg, and I was previously working on a cryptocurrency trading platform called Tiger Trading, and I'm now focused on a new stablecoin project, which we won't talk about here. But you know, Sam, I do want to reach you offline. I'll DM you, and I have a question for you. But just real fast. So yes, working on a new stablecoin project that essentially is built to deliver an average return of over 8% per annum, and also have the peg insured to maintain a one-to-one stability throughout. So it's interesting, but it's early days, so we're just getting started with it. And the project we're looking at is agnostic to protocol. We're looking at Stellar because I think it's got a lot of use case with regard to remittance, and then in ERC20 because we want to list it on different exchanges. And so I always get a little curious, if you will, about the algorithmic coins and how that works. And Sam, my question to you is to understand a little better. And actually, Josh, you started to, you alluded to this a little bit when you talked about DAO getting crushed when Ethereum got smacked back on March 12th, I think it was. And so I just kind of wonder, with regard to maintaining a one-to-one stability and how the system is going to print more tokens and auction off more fracks when the coin dips below $1. I just get a little more clarity on how that works and maintains the system.
Thanks, Glenn. Sam?
Yeah. Well, first of all, would love to chat outside of this too. Yeah. So the main thing is, it's almost like, imagine these algorithmic stablecoins. It's almost like having, the protocol kind of be represented as the Fed, and then this other token is kind of shares in the Federal Reserve, right? And so imagine if, right now what the Fed does when they want to retract supply of dollars, right? They issue bonds, they issue treasuries that have different percent interest rates, and then people purchase them with dollars, and then the Fed takes the dollars out of circulation. And then, they might print them back into circulation later, like they're doing right now. So the expansionary power of the system of algorithmic stablecoins is infinite, but the retractionary power is pretty much limited to the market cap of, the utility token. In Frax, it's Frax shares. So is there like a specific part of the question I can expand on that you want to talk about?
Since there's only a few minutes left and somebody else has a question, I think we should take it offline. It's still a little unclear how, if there is a run, how that's prevented. I get it fundamentally. It just is a little unclear to me how that if things get really dire and people really want their money back, how you prevent it from, even with additional auctions, where you get the demand for that and how it continues to maintain its peg.
Yeah, I guess what I'll end on though is that's actually exactly part of the reason with Frax we want to make this completely collateralized at the beginning, and the protocol very, very, very slowly, like I was describing, moves to more and more an algorithmic phase as the whole market cap of the system grows. You could see how it would be a disaster with something like Basecoin, right, or Basis. It's just, how do you even do all of these market operations with their so-called stablecoin that has zero collateral? It's not worth anything, right? It's that I totally agree with you on. And so that's kind of what motivated us in how to design Frax and make sure it's 100% collateralized at the beginning and very collateralized in its infancy.
Okay, thanks, Glenn. Happy to hook you guys up. Thanks, Sam. And now for the, I guess, last question, Kathia.
Oh, hey there, it's Katia. How are you?
So close.
Oh, that's okay. So yeah, I've been following, I'm a part of the Hedera community. I'm an ambassador in the Boston area, and I have been reading about Carbon, but they've sort of fallen off of, I can't get any information about what's going on with them. So I was just wondering if you took a look. They started off super well a year or two back. Wondering if you've maybe learned from any of their mistakes, or if you have an update on what's happened to them. And where do you think you're stronger than they are?
I actually, it's funny. I really like Sam Troutwine, the CEO. I was actually an early advisor to Carbon, believe it or not, because I was, preaching about stablecoins, like I said, since 2018. They've actually pivoted to payment rails. Carbon was an algorithmic stablecoin design, similar to Signer shares, the list of stuff I had in the PowerPoint. They're not making that anymore. And so I think the important takeaway here is everyone that seems to be trying very hard with very, very intelligent people, smart people, and even funding with teams like Basis, they fall flat on their face with the algorithmic stablecoin design. And everyone always says algorithmic stablecoins are the holy grail, and they're highly scalable. Why is it that no one can even deliver like even a half working product? Our claim and our unique idea, hopefully it's right, is that it's simple, because they just started on day one with zero collateral and there's zero confidence in the system. How do you actually get people to use a so-called stablecoin that has absolutely zero backing from day one? The US dollar was backed by gold until the 70s, right? And so Frax takes that idea, and that's why we start with 100% collateral, and then hopefully one day fully algorithmic, like the other attempts.
I missed the front part of this meeting. Will your presentation be available, or could you send it to me?
Yeah, we'll be up on YouTube, the whole thing, and we also do a blog post, the 5 or 10 lessons learned. So thanks a lot, Katia.
Thank you.
And actually, I'll take the last question because we got a couple minutes left, and I'm super interested in your guys' views on, if we were, and obviously this is a hard question, but if we were going to have this call next year at this same time, what do you think we'd be talking about then that we're not talking about now? And I'll start with Sam.
That's a great question. I think we'd be talking a lot about stablecoins being used just in payment apps without the word stablecoin. I genuinely think, Venmo, Venmo or PayPal or something, they're going to have stablecoin support. No one's going to be talking about the word stablecoin.
I mean, so then what do you think, to the degree it's even right? But if we talk about market cap, what do you think then the market cap of stablecoins are?
Ooh, okay. I've been decent on predictions so far, but that's really tough. I would say next year about this time, I would honestly say over 100 billion. Over 100 billion.
That's some good growth. It's a 10x, right?
At least.
Right.
Yeah, I think a 10x is definitely possible. I think we'll in a year from now, hopefully we'll have some evidence around what the implications of like Libra and the Chinese CBDC will be as well. And I think those two are going to be the biggest on-ramps that we have in crypto. And so I think it's going to be a positive for the crypto ecosystem as a whole. But I think easily, like Libra alone could be a significant part of that 10x in market cap.
Yeah, that's so I guess your headline would be the on-ramps are coming.
The on-ramps are coming, absolutely.
On-ramps, right? Which is what we've highlighted on this call is such a major problem. So, so Josh, you get the last word.
Yeah, I mean, I don't know if I have anything particularly unique. I mean, Roy took my part. I think CBDCs are going to be the conversation we're having next year. I mean, they're coming. We'll see.
China, I know we've talked a lot about China. They seem to be out ahead.
Yeah, and I can't remember all of the countries off the top of my head, but they're not the only country. That's, the US is, I don't know how seriously they're considering the digital dollar, but the fact that it's even become part of the conversation, and I forgot who I saw said it the other day, but the fact that, money laundering is so easy to do with fiat currency because it's untraceable. And if you're a government and you can use a digital stable currency and you can trace where money's going, like I think it was Elliptic maybe, or somebody put out research, maybe it wasn't Elliptic, but like at one point, 90% of all crypto that's in circulation 15 transactions ago had been part of some sort of illicit activity. I mean, this is a long time ago, right? Now like Binance was able to stop some money from a hack from, they froze some of it on their exchange this morning. And so that's great and all that. But the point being that central banks and governments can monitor how currency is being used and who's using it. And so I think that's huge. I think that's going to be a big discussion in the future. And I think every currency will become electronic. I don't think there's any need to have fiat. In terms of stable coins, aside from CBDCs, I can't, give you a projection on growth, but if this current growth trajectory continues, I mean, it's going to be huge. It's for remittances, especially in where you have these different, different countries that are just like the United States that are printing trillions of dollars. There's a need to move to safer havens. And I love the argument for Bitcoin to be a hedge against macroeconomic uncertainty, but maybe there's some basket of assets in a stable coin where people in a place like Venezuela can move their capital to. So they are no longer at risk of their currency inflating by 10,000% in like a week. So I think those things are going to be big.
Yeah, and for me, and thanks a lot, guys. Thanks a lot, Josh, for that. Just for me, because I get to end it. I was on a call like 3 weeks ago. It was an EY, and I might have mentioned this to you because it was a real moment for me. Blockchain conference call, and they did it like 3 days, and it was great. And one of the panels they had that I listened to was on stable coins, and they had somebody from the Fed who talked about how their primary goal was safety and security, which, okay, hard to argue with that. And he said, and as a result, we're not going to be programmable, right? So the U.S., whatever the U.S. current digital currency isn't programmable, that means there's going to be something else that is a representation of that, and that's where all the or multiple ones where there the innovation, right? Because the innovation to come from making this programmable, I think, is mind blowing. So anyways, so thanks a lot, Josh. Thanks a lot, Roy. Thanks a lot, Sam. Thanks a lot for everybody in the audience, everybody who asked questions, and we'll see you at Stablecoins 4.
Thanks, Lou. It was awesome. See you guys.
Thanks, Lou.
Thanks, Lou.